Ready to get started tonight. Welcome everybody to the University of Chicago Francis and Rose Yuen campus here in Hong Kong. Welcome to those of you who are here in person and those who are here online. Tonight we have a talk called the Algorithmic Financial Advisor's Dilemma. And as always, we're sharing the program on Zoom and Facebook and YouTube, and you know how to submit your questions on Zoom by now, so I don't think I need to belabor that point. I do want to encourage you that if you're not already signed up for our e-news, you can find out about all the things that are going on this campus by signing up at www.uchicago.hk and just click on the subscribe button to get on our latest e-news. This program is really special to me and to the team here on campus, the global team on campus. The Nexus Asia program is something that we came up with probably, I think in May, where we thought, how do we activate this campus even more, leveraging the expertise, the knowledge, the relationships that our PhD alums from UChicago have in the Asia Pacific region. So we launched Nexus. We quickly put out a call for proposals. We had 10 proposals. We accepted all 10 proposals. Ben's was one of them, of course. And really, I think this is our 5th Nexus program since we launched Nexus just a month and a half or so ago. And I'm just really excited about it. It's our way of connecting with our UChicago PhD alumni and their institutions across the Asia Pacific region. It's very easy to bring them here. They seem to like coming here when we invite them to give talks, lectures, academic workshops, symposiums on our campus, and to actually engage in research, which is our UChicago tradition. So tonight we're happy to have Professor Ben Charoenwong with us. Professor Charoenwong is an associate professor of finance at INSEAD and an affiliated faculty member with the Asian Institute of Digital Finance and the NUS FinTech Lab. He completed his PhD at UChicago in finance and got his MBA at the same time, or I guess one right after the other, at UChicago Booth School of Business in 2017. I just spent a little time with Ben, and he mentioned that he was a TA here in Hong Kong at Cyberport back in 2017. So we're excited to welcome him back as an alum, as a former TA. It's really exciting to have you back. Ben's research focuses on financial regulation, fintech, and networks, and has been published in journals like the American Economic Review and Journal of Financial Economics. His research has also been cited in policy reports by the United States Securities and Exchange Commission and has been covered in multiple media outlets like The Economist, Reuters, and Seeking Alpha. We still have some people trickling in tonight, but I want to get this program off and started. After talking with Ben, I have a strong feeling that we'll all be really interested in this topic tonight. So let me turn it over to Ben.
Great, thank you. And thank you for having me here, and thank you for coming over. Yeah, so most of my work is in financial regulation. We kind of have this framework that financial advisors, although they add incredible value to their clients, they may also commit misconduct, right? And some kind of, there's a long literature done by my advisors, and I'm part of that literature as well, thinking a little bit about how can we use technology to improve financial advice. Okay. So the topic for today, it's going to kind of summarize the state, I think, of the research, and then I'll also include a little bit of my new research results as well. This is inspired by some project I've been working on that is relevant to the Monetary Authority of Singapore, where we're trying to create LLM evaluation for financial advice. Okay. So I thought this is a good motivation. Does anyone know who this guy is? Rich Sutton. He won the Turing Prize for reinforcement learning, which gave us DeepSeek. So his stance, and he's somewhat of a radical, is that experience beats knowledge. Don't even teach the AI anything. You just need to define the appropriate reward function, and then through enough trial and error, it's gonna figure it out. Okay. So that's kind of radical, and I think most people doing applied work, specifically thinking about these tools, machine learning and AI, as applied to financial markets, won't have like such a strong stance that should kind of throw out the textbook and just relearn everything from scratch. After all, we're UChicago, right, where a lot of this work was developed. But nonetheless, it's coming, right? So I think companies all around the world have been investing heavily in AI, and I'm most interested in thinking about financial advice. Okay? So the practical point here, most problems with AI is one of evals, right? So if you're a product manager at Amazon, you're no longer just communicating between your customers and your devs. You're actually designing the process to think about how can you build evaluations so that your process can improve over time by itself. Okay, so today I'm just going to try to do a couple things. Kind of try to frame the context of financial advice, going all the way back to 1952, right, with Harry Markowitz, and where did that kind of field go since then. I'll talk a little bit about some of my new research, thinking about developing a large language model evaluation, and then I'll also emphasize what can go wrong when you're deploying the technology in a way that is actually misaligned with your client. And the punchline is actually, in most financial markets in the world, when you provide financial advice, you're not legally required to act in the client's best interest. Okay? In the United States, we have something called the fiduciary duty. Legally, they are supposed to act in your best interest, but that standard does not apply in other markets. So for example, Hong Kong and Singapore do not have those same standards. Okay, so I'll talk a little bit about the evaluation framework. Effectively, I'm going to take the CFA, I'm going to take customer complaints, we're going to process it, and I'll show you some evidence on if you took off-the-shelf models and started to evaluate them along these dimensions, what could possibly go wrong, and where will the model work, and so on. Okay, so I just want to do three things today. I'll try to make a case that we want to think about AI for financial advice. It's kind of tricky because you can't just take a model that says, hey, let's give you a recommendation of what stock to buy, right? And if you buy that stock, I can't calculate that as a reward. Why? Because if you do that, you can actually end up getting the machine to quickly learn your behavioral bias, and in fact, end up taking advantage of you. For example, it saw that you bought Bitcoin, and so it's going to recommend MicroStrategy, right? So when we're thinking about standards and ethics in terms of financial advice, we're not just thinking about, are they actually going to pick something that I recommended? Yeah. I'll talk a little bit about the empirical findings. I think if we're trying to take AI models and scale it for financial advice, I'll try to quantify where kind of the advice quality may break down. And then we want to think about having this evaluation framework for the industry. So this is part of a project where we process all the public filings of customer complaints. We actually create the eval. We're going to open source the eval, and then we'll also open source the code base for banks and asset managers to actually also use the library to create their own evals. Okay, so the idea here is simply, I'm going to talk a little bit about points of caution, right? And why I think technology by itself is not going to fix the problem. There's like a fundamental misalignment in financial advice that even with technology, actually you might end up getting worse outcomes. Okay, so Americans invest about 20 trillion in retirement accounts. In terms of the fees that they pay, it's about 28 billion annually for financial advice. Most people, when they participate in the financial market, they do it through a financial advisor. They might be a tax planner, a wealth planner, right? Or you might just use Robinhood, right? In that case, Robinhood is your financial advisor. And so we're going to think a little bit about, as the frontier is moving and AI is developing so quick, can we use some of that technology to actually innovate, to actually create like new products and new services, and what should be the kind of the pointers that we should keep in mind. Okay. There's a tremendous amount of spending, a lot of it by banks, right? The framework that they have now is, I think, kind of simple. There's all this work on AI co-pilots, right? That's kind of this human-AI collaboration. Number two, we're going to start to have hyper-personalization. I think that's where the industry is going to go, right? And then, of course, we have the low-hanging fruit stuff, these kind of AI web crawlers for automation and the kind of cleaning up the back office type stuff. So a lot of the investment so far is in the kind of low-hanging fruit. We're just going to make the process a little bit more streamlined. But to me, the thing that's actually quite interesting and promising is actually this hyper-personalization component. Okay? It's worth noting that fund structures, right? Funds, when you invest in a fund, we're using a legal entity that was created in 1920, right? Nowadays, everyone has these investment platforms. So I feel like the custom portfolios is going to get implemented directly in your trading account without needing to go through funds in the future. Yeah. There's also like a bunch of Chicago alumni working on this kind of AI co-pilot. So I know of someone who's developing an AI co-pilot for private equity, a company called Bright River AI, where they actually created this corpus, right, to actually help you do the due diligence. So I think a lot of this stuff is starting to come. I'm actually quite excited about the hyper-personalization component in terms of rewarding and providing advice and nudges and so on. Okay, so we just take a step back and think a little bit about financial management. Wealth management is a regulated service. You have to have a license. You do things like budgeting, investment planning, tax planning, risk management, and so on. And the idea simply is to improve your lifestyle and legacy. Okay? It has all this other stuff in it, right? What stocks should you buy? What funds should you invest in? But also there's philanthropy. There's social emotional wealth. Okay? So a lot of the work, actually, when you're thinking about financial advice quality, we're focusing a lot on this kind of social emotional component, not just the P&L or the dollars or the Sharpe ratio. When we talk about financial advice, really I want to not just say, hey, you should buy these 3 funds. You should actually have more advice in terms of understanding what the economy is doing, what are the underlying risks. So baked in that financial advice is not just recommendations for funds, but also education. So wealth management 1.0, right? All based on personal trust. That's definitely still the market now. A lot of manual processes, and it won't be a Chicago talk without talking a little bit also about the Nobel Prizes that kind of got us here. So we're thinking about the first kind of set of financial advice. You really have to think about Harry Markowitz, right? His whole thing is don't put all your eggs in one basket, right? Some risk in a portfolio doesn't need to be there. Therefore, you do not get paid to take those kinds of risk, right? So you have this framework of bearing risk, right? You only take risk that's rewarded, right? Of course, then we have the CAPM with Bill Sharpe. And then we have Gene Fama, who says financial markets price in relevant information very quickly. He also developed, of course, the Fama French factors, right? So we went from portfolio theory, CAPM, to multi-factor portfolio, right? David Booth and so on, of course, running DFA. And then we also have, predictable returns. So actually, the fact that you can predict returns doesn't mean that the market's inefficient, right? So when we're taking these 4 kind of findings of these Nobel Prize winners, we're going to apply it now with technology. What do we get? Okay, so we have electronic trading, right? There's a shift towards more data analysis. Harry Markowitz back then, for his dissertation, Milton Friedman was not happy about it. He said, this is an engineering paper. This is not an economics paper, but we'll still give you your economics PhD. right? But he really was the first person to bring in engineering optimization into a portfolio problem. And so where has the financial advice gone over the years? We started with portfolio theory, mean variance efficiency. Turns out that's not how most people think. Nowadays, pension funds are still using those frameworks, right? There's some practical limitations. There are companies all around the world, billion-dollar companies built on how to actually help you optimize your portfolio. Okay? And then we have this kind of factor-based investment, right? That is not just portfolio theory, but let's have CAPM and multi-factor, and we're going to deploy it through ETFs and mutual funds and so on. Where some of the literature and practice has gone is, of course, bring in more machine learning applications, things like alternative data, kind of nonlinear models and so on. But to me, the interesting part actually is the next frontier, that is this AI financial advice. Things like personalization at scale. If you're behaving, you're trading a stock and you're starting to like take a little bit too much risk, it starts to nudge you, things like that, right, to kind of help you improve your outcomes. So kind of broadly, that's where I think the market is going to go. I'm happy to chat more about it. I'm going to actually quote Harry Markowitz. It's quite deep because people think that all he did was kind of bring math in to portfolio theory, and then you kind of just invert a covariance matrix and you get your optimal portfolio. But actually, he was like also quite involved with industry. Okay, so this is his quote. Perhaps the most important job of a financial advisor is to get their clients in the right place on the efficient frontier in their portfolios. But the number 2 job, a very close second, is to create portfolios that clients are comfortable with. Advisors can create the best portfolios in the world, but it doesn't matter if the clients can't stay. Right? So despite doing all this math, at the end of the day, it's actually a human problem. Right? It's a relationship management problem. So when we think about how do we deploy AI, we have one way, which is robo-advisor. I almost went to work for one. That is, you just take a survey, right, and they put you in a different sets of buckets of funds, right? Or you can actually have this combination of the human and AI component. That's kind of the co-pilot approach. Robo-advisors, there's some in pretty much every market. They've grown really fast. Their fees are very low. So like as an entry point to start investing, these robo-advisors seems like a good place to start. But if you have a little bit more complex situation, more optimization that you need, it feels like this kind of second part here, that's what the private banks are trying to do, to bring in the human and AI and still have the human maintain the relationship, and then we're going to have the AI supplement with the reporting, right, and so on. It's quite interesting because despite the fact that like we have all this technology, you still have issues, right? So here's Charles Schwab. They were fined about 190 million. And what they did was actually they purposely, in their algorithm, right, allocated more money to cash. And what they weren't telling the clients was that the cash would collect interest, but Schwab would take the interest and not pay it out to the clients. And so it started generating a lot of cash drag. Okay, so this is like pretty egregious, right? Because they actually audited the code and said, hey, your algorithm is optimizing for revenue. Your revenue. You're not optimizing for the client's best interest. Okay, so then they get sued. JP Morgan, similar. They didn't disclose their conflicts of interest. They would recommend their own funds that were more expensive and inferior to the other options that were there. So the more you move towards black box, right, like you get like this fund recommendation, you don't really know how that recommendation is made, right? All you get shown is just a list. And so it becomes quite hard actually for the client to try to parse through and figure out what is the engine trying to optimize for. Okay? So Ant Financial in China, right, when they have a mutual fund platform where you can buy funds, they purposely did not want to rank funds. They didn't want to provide financial advice to say which is a good fund, which is a bad fund. And so what do? They use the default, which is sort you on your returns. And of course, what ends up happening is people will just chase the top performers, right? And then you get this mean reversion. Right? Again, the fact that they did not want to provide any financial advice doesn't mean there's no implied financial advice. Okay? If you say, I'll just do the default A to Z, right? That's actually, that ranking itself implies something. Yeah. So the fundamental misalignment here is that there are inherent conflicts of interest in the relationship between clients and advisors. Okay? Financial advisors know much more than clients. There's asymmetric information, and there's agency costs. In many countries, they earn a lot of commissions. And it turns out sometimes they don't disclose. All right? So imagine like you go to see a doctor, and the doctor's not required to act in your best interest to help you get better. And he can actually earn commissions from the drugs that he prescribes you. That's kind of how the financial advice market is. So this is a rundown for the different markets in Asia. You can see here, most of them do not have a fiduciary duty. Taiwan, South Korea have it. Philippines has it because they have adopted the US framework. But you can see here, that actually means in those markets, your financial advisor doesn't have to act in your best interest. In fact, when you open a private bank account in the US versus in Singapore, you have two different contracts. Okay? So there's actually like a lot of work for people to say things like, hey, I want my account to get booked in America because I'll have more protections. So how bad is the financial advice? They're very important for the industry. Again, this is how most people save money for retirement. But 1 in 5 advisors have a history of misconduct. Okay. This is for America, where the data is publicly available. I don't have the data for Hong Kong. I don't have the data for Singapore. We tried to ask. The regulator didn't want to give it to us. So I suspect the number is higher. Okay. In terms of the problems, you could see the most common problems are unsuitable advice, misrepresentation, and unauthorized trading activity. Unauthorized trading activity you can deal with reg tech. That just means you can't have your advisor come trade your account. All right? Unsuitable advice, that's much harder to figure out. Right? What does it mean it's unsuitable? And usually it's only unsuitable after you make a loss. Right? If you told me to take a lot of risk, but it did well, I don't complain. Right? If it doesn't do well, suddenly I ask the regulator to step in. So I want to highlight this because the fact that we have more technology does not mean it's going to fix everything. In fact, right, from the examples in Schwab and JP Morgan, the technology can actually exacerbate the problem. Right? So if you're harvesting AI to make more informed decision, to have more reporting for your clients, probably that's a good thing, right? But it can be used to exacerbate the problem if you don't even know what's the objective function, right? So if you're being sold all this stuff, but you don't know what's the algorithm they're using to actually show stuff to you, I think that's a potential problem. And there's actually no framework right now, no regulatory framework for us to think about that. Okay. So the classic principal agent framework, and I'll get into a bit more specifics, is simply that your advisor may prioritize their own interest over the client. How do we solve this? We penalize them. We throw them in jail. We fine them, right? Just kind of whack them. So the fiduciary standards, right? You have disclosure requirements. You have all this regulatory oversight. And so the question becomes, when we think about AI-specific agency problems, what is the objective function? And again, I think if you take reinforcement learning and say things like, I just want my customer, to like the fund that I give them. Like that's kind of like a very vague concept. Okay? You might say, okay, I want to maximize my client's Sharpe ratio. Right? That is risk for reward, reward per unit of risk. All right, and there you kind of go back to the standard portfolio optimization stuff. And also, there may be systematic biases. So I'll show you some evidence of that. There's some emerging literature, right, on AI biases. Somehow the AI learns to become racist. Why? Because people are racist. And so I'll show you some evidence when we're running these experiments with the AI, like where we think actually some of the advice quality is pretty shaky. So when you're thinking about bringing these digital platforms, you have to kind of tackle the problem of how do you attract new clients, right? Typically, if you're a broker, the way you get new clients is you give them a free Apple share, right? Customer acquisition is extremely expensive. And then you want to focus on performance metrics. Actually, the metrics that brokers care about is not your performance, right? It's how much you trade. So when I was talking to a broker, they asked me, can I help them build an AI that just gives them a bunch of different trading ideas? Right? And I said, does it need to be good? Does it need to be grounded in academic research? No, just give me something interesting, right? To get the clients to trade because I make money on commissions. Okay? And you also have to do it at scale. Okay? So I think there's like some brokers in China that have started rolling out large language models to be a chatbot to actually give financial advice. And we're all Chicago people. So what they did was, they took a class learning CAPM, and they taught their large language model to nudge you if a stock that you hold has an alpha with a t-stat less than 2. It's kind of weird. That's not like a standard objective function. We're just saying, hey, these things that you hold actually don't have good alpha. Right? Of course, we go to this very long literature and long discussion, like what is alpha? Is it skill? Is it luck? Blah, blah, blah. But there, again, why is it that you hold something that goes down, t-stats less than 2, I'm going to say, hey, you should sell it. That's kind of a strange framework for providing right financial advice. But somehow the clients seem to love it. Okay? They love the chatbot much more than talking to a person. Why? Because it's much faster in their response. Another challenge when thinking about financial advice is we're trying to figure out, is it misconduct or maybe your advisor is just dumb? I think when I started this research, we really thought like, oh, advisors are always trying to take advantage of their clients, they earn commissions and so on. But there's actually now more body of evidence that actually suggests when they're actually looking at what the advisors themselves trade, like they usually do the stuff that they recommend their clients. So if they say, hey, buy Bitcoin, like they also buy Bitcoin. So in that case, is it bad advice or maybe they just have biased beliefs, right? And again, where you layer in the AI, I think has very big implications. So let me just motivate the research that we're trying to do. So that's kind of the backdrop, and I'll get into a bit more evidence. So the case we want to make is there's been this growing field, right, of co-pilots. That's kind of the low-hanging fruit way to bring AI into the market. But I think it's moving towards LLMs being deployed for financial advice. Robos manage 2.5 trillion now globally. Major banks are trying to bring in AI assistants for wealth management. And the challenge is, like, how can you have a good evaluation of whether or not this is like a good piece of financial advice? The standard frameworks that we have are like math questions, right? So that's kind of easy to check. And so what we're going to try to do in this paper is actually combine different data sources to construct the new eval. Okay? So I want to make the case that existing benchmarks for financial advice are insufficient. Most AI evals now test capability, not appropriateness. Okay. Many of them are synthetic test cases. There's no regulatory alignment. And again, even if you want to do it right, different markets have different standards. Okay. So specifically for financial advice, the suitability really depends on the client's circumstance, right? And you have a lot of objectives, like you are trying to balance risk and reward, but you also have like retirement goals. And so there's actually a whole host of objectives that you want to try to satisfy. And the problem is we need an evaluation framework that's actually grounded in what we would call good advice or bad advice. Okay? And I'll add that just because you're compliant doesn't mean like you've reached the appropriate level of consumer protection. What I'm going to show you evidence of is that these large language models do quite well in terms of the CFA style test. So when I'm actually asking them math, when I'm asking them portfolio theory, they pretty much nail that stuff. But when I take like a complaint scenario and actually ask them, right, what would you do in this scenario, the quality actually starts to tank. Okay. So I want to make the case that the professional standards themselves are inadequate, right? Because it's mostly technical and capability driven. And so we need like a broader framework. So I'm going to draw two pieces of data. The first is going to be stuff from the CFA. Has anyone here done the CFA? Yeah, was that fun? So part of the CFA is like kind of math and portfolio theory, but a big part of that's also ethics, right? And this is a standard where in many countries, actually, if you do the CFA, you can fast track to get your license, right? So it's like fairly well, it's fairly, I think, well received. There's a bunch of standards. You see professionalism, integrity of capital markets, duty to client, duty to employer, investment analysis and recommendations, conflicts of interest, and other responsibilities. The idea here is when you're in an advisory relationship with a client, members must take reasonable inquiry into client's investment experience, risk and return objectives, financial constraints prior to making any recommendation. So I'm going to take a bunch of these CFA type questions. I'm going to have 35 of them. And then I'm also going to look at customer complaints. Customer complaints on financial advice, I have about 160,000. But a bunch of that complaint is like super egregious, meaning some of these customer complaints are straight up just like legal cases where, for example, the client has an insurance, life insurance, and the advisor changed the name of the beneficiary to be himself. Okay, so that's like super egregious, and that's a little too obvious, right? So there's kind of like the clear violations, and there's a bunch of frivolous complaints. For example, my private banker took me out for lunch and he made me pay. Okay, and then so you file a complaint. And so we really need to kind of parse the data. So you go through this 4-step process. So I'm going to start with like 160,000 regulatory disclosures. We first filter, right, to make sure I have enough information on the scenario. That is, hey, you sold me a variable life insurance, right, while the market is going down, and then there's like an option baked into it. So it's actually gets like fairly involved. And what we're going to do is we're going to extract the scenarios with a large language model. We actually need like a pretty good reasoning model for this. Then we're going to construct these questions, dedupe them, deduplicate them, and then we kind of validate them. So what I do is actually just run a bunch of experiments with these large language models to try to gauge what's the quality of financial advice. I'm using 6 models, 5 different client profiles that actually we just get from FINRA, and a bunch of scenarios, 15 scenarios altogether, 450 combinations. We run it a bunch of times. So pretty much we're just prompting, we're giving this case, right? So we have your professional reviewer of financial advice. Here's your client. Here's the case. And then here's the option. Which do you recommend? Okay. And what do we find? There's actually big dispersion in advice quality. Okay. So it seems GPT-4.1 is pretty good, and Gemini is not that great. The thing that I was quite interested in is if you ask the same question multiple times, the LLM is actually remarkably stable. So first, I actually suspect that the advice may be fragile, meaning you ask the same thing multiple times, you get quite different results. But actually, the within variation, the consistency measure is like above 96%. So it just seems like some models are just lower quality than others. Yeah. And I'm showing you here the scores on different dimensions. The x-axis is the score from the CFA type questions. The y-axis is the score based on the complaint scenarios. And what I want to show you here is that in general, okay, the models are better at nailing the CFA type standards questions compared to the complaint scenarios, which are real world failure modes. Yeah. What does it mean? I don't get too technical, but it seems based on the different client profiles, you're getting like a pretty big variation in advice quality. Higher score is good in this case. And so we actually estimate the individual impact to be like between $2,000 to $5,000 on a 100K investment balance. So I'll do the back of the envelope calculation here. So I'm drawing on some work by John Campbell. He argues bad financial advice reduces household wealth by between 2 to 5% annually. The typical investor portfolio is about 100K. What we document is actually across the different client settings, right? There's actually big variation in advice quality. That's between 20 to 40% difference. And it's actually, so it's actually quite good at giving high quality advice to women, which is not how humans are. Okay? When we do these audit studies, so you run these experiments, actually in Hong Kong, they found that women tend to get worse financial advice. So they hired like these 400, so this is professors at HKUST. They hired like 400 actors to go and to pretend to be customers and actually would talk to the advisor. And the financial advisor, when they're selling products to women, tend to sell stuff that is less diversified. Maybe because it's like an easier story. It's like one stock. But the idea here is these large language models don't seem biased against women, but it seems quite biased against the elderly. So if I switch it to be like an old client, they tend to have worse advice. So we can actually, from this, do some back of the envelope calculation. If in America you have like 25 trillion vulnerable population share, that is based on the FINRA definition, if you're a vulnerable profile, like a single mother, struggling, a recent divorcee, the potential welfare loss, if we just rolled out large language-based advice, was between 500 billion to 1.2 trillion. So you really want to keep a close eye on exactly where the biases are emerging. So the nice part about large language models is you can just do this, meaning we can just run these experiments with them. They don't get tired, right? So I can come up with different models. We can look at different client profiles and actually gauge where's the advice quality the worst. Yeah. So when we did this, I thought this is like a pretty big number. And so now the next step is thinking about when we're trying to deploy this live, can you use the eval to actually fine-tune your model, to actually try to improve the quality of advice, specifically among the vulnerable population? Will this stuff scale? I think that's interesting. It's something that I think about quite a lot. When you're starting to give this AI-based financial advice, right? You actually want a system that can improve over time as the market situation changes. So that's why I think bringing in the complaints data is actually quite useful for this case. So the challenge with trying to use AI financial advice is transparency, right? We don't know exactly what is the objective function. Israel first licensed a large language model to be a financial advisor. We don't really know what the consequences of those will be. Okay. I think the US still doesn't have a clear framework for that. I think there's a regulatory need to think about oversight and evaluations. And so, I was talking to Monetary Authority of Singapore, and they cared a lot about thinking about these evals, right? And trying to figure out what kind of pockets of the population are going to be most exposed or where the advice quality is going to be worse. Okay, so I think this is like not a smoking gun, but it's a first step to thinking about how we can take AI financial advice and kind of give it guardrails. Okay? And the nice part about these complaints is actually they're driven by the customer, meaning they filed a complaint, therefore they were not happy. So you can use this to actually improve your system going forward. Okay, so I'll just close on this slide. So I think it's pretty obvious that large language models are super promising. There's a growing field of they call it robo-psychology, where you're kind of like trying to figure out what's the personality of Claude or DeepSeek, right? And they have like an implied risk aversion. It turns out a lot of the stuff that we do for AI alignment effectively changes its risk tolerance, okay? And so some models like Gemini just always wanted to take less risk, even in situations when you want to actually grow wealth. I keep saying like put money in your deposit account, right? Which is also not that appropriate. And then some like Grok just take way more risk. Like Grok is a little off the chains. Yeah, so I think it's pretty unambiguous to me that this stuff is going to come into the market. The fundamental incentive misalignment is still there, right? Meaning, like when I talk to this broker, they just want to generate more trading revenue, right? They just want to generate more trading volume. They don't really care about the client's returns. And so I think there's like a scope in the market for trying to build something that's a little bit more tailored in terms of the investor education. I think the developers and platforms need to align. And the problem is they don't have an incentive to. They're actually not incentivized to give you good advice, right? Because they actually want to generate more trade. So I think that's not going away. It probably will get worse. Okay, so I'll end here. Thank you. Questions, comments, concerns, rude remarks? Is anyone active in this space trying to bring LLMs to the market? Yeah.
Years investment research, head of research for a mutual fund, and now trying to do a startup that's trying to get an LLM into wealth solutions. Right. So the biggest problem that we've faced is exactly what you said, that there is no benchmark for right advice. Most of the times, right advice is only seen in the long term,
right,
and that is hindsight. That's the problem most of these people face in addition to the incentive. So we are basically focusing on automating most of the routine, regular advice, where there is a challenge of finding the talent and communicating properly, that sort of stuff. So that's where we operate in.
That's kind of like the low-hanging fruit stuff, right? Like let's automate the process, the documentation, let's put in the RAG. But yeah, so I think it's still like, will the AI actually tell you what to buy and sell? I think, yeah.
As you've said, in Asian markets, the regulation is quite lax. The fiduciary duties, I don't believe it even exists in the US. I've been in a bunch of firms, all of who have been filed for not having a fiduciary duty and charging more commissions. So the problem over there is, LLM or not, advice is going to be given.
Yeah.
The brokers and everybody are going to generate 20 trading ideas a day. And there's no research model that sort of justifies this. Automating that sort of stuff with a little bit of quant background improves the outcomes dramatically,
right,
compared to the current advice that these people get. So that's what's going on. But the challenge, the question to you also is, what we've seen is most of these LLMs are not built for expert level advice. So they are generic LLMs, and we are hacking ourselves into the financial world. And so ROIs on these are pathetic. So they're not moving beyond the demo stages to offer any financial sort of advice.
Yeah, so it feels like the value, it just hasn't been realized yet, right? Like as a proper use case.
Absolutely.
But to your point, again, like kind of understanding the standards and compliance, I think that's not hard for the LLM to do, right? Like if you say like you have to disclose, right? The LLM can disclose, right? But yeah, like you said, when it's actually offering advice, like you want this or that, that's when it kind of gets a little more hairy. The challenge is, of course, not having a framework is a bad framework,
Yeah.
right? And so the regulators who don't have a clear framework on how to think about this, it will come to market, right? And then the companies will compete to see which will stick. But we are kind of like seeing the financialization of everything. But you're right, actually. So I have this data on retail traders. The average account holds 5 stocks. Okay, 5 stocks. And so just like a nice nudge to be like, hey, buy an ETF can already diversify them quite a lot. And so yeah, there's a lot of this very low-hanging fruit thing that I think I think there's a lot of scope for kind of the simple stuff that makes like a pretty big difference. So like if you're trading at 2 a.m., right, it might give you a nudge to be like, are you sure?
Yeah.
So I think things like that, this kind of guardrails, this kind of Dick Thaler type stuff, right? I think that actually seems like very, very fruitful. Yeah. Yeah.
So in your last point, it seems that you are saying some of the LMS themselves have some risk preferences. Well, if we look into the deep of how is the LM working, it actually depends on the parameter, so-called temperature, that was set by the model builder. So to my point of view, how does we as a model builder or as a sort of driver to develop this kind of algorithm, and then to make sure that this LM, they are actually trying to process those processable or automaticable kind of the procedures. Well, for a lot of this decision making, I would rather to deploy it to a human where they can really match the risk appetite of the investor, of the client,
Right.
and the risk investment objective of the client. I think that is something that I think the financial regulators really should think about. What kind of the responsibility we can deploy to this automatic system, and what kind of the responsibility has to be bared by the advisor, human advisor.
Yeah, I think at the end of the day, financial advice is about trust, right? And the problem is it's not a single objective function, right? Like I said, I don't think it's a problem of maximized Sharpe ratio, right? For most people investing, you have like liquidity constraints, you have to send your kids to college, all this stuff. And a big part of financial advice is actually like, we call this money doctor. Like it's kind of emotional support, right? When something happens, you explain, right? Yeah, I think that's like a big piece of financial advice that, yeah, to the point earlier too, I felt that there was no eval, like we had nothing, right? Because we're just testing capabilities, right? We're not testing, to your point, the appropriateness. So yeah, I brought this slide back because actually, when we're looking at the cases, it turns out putting in, like you have to put in the appropriate client profile. This is actually very important. It's not like, should I buy Bitcoin? It's really for you, for your situation. And the thing that we found was that the LLM is quite good at adapting to different profiles. So certain models will have like certain levels of risk. I think this is an outcome of the alignment, kind of AI safety. But you don't want to just take it off the shelf. So really part of this is thinking about when you're prompting it, what information should you give it? This is like quite deep, I think, because if you think that like an AI is racist, maybe you don't give race as a part of the variable for the scenario, right? And so actually like having the right prompt template on what information do you want to share, yeah, and then what are they good at, right? I think this is the first step to understand. Yeah. Yeah.
On the LLM scoring chart, I just wanted to understand your framework for appropriateness. For example, GPT 4.1 is more appropriate than Gemini.
Yeah.
taking the example you shared for the older demographic, perhaps the advice is not as appropriate. Is that how you're measuring that?
Yeah, so from the standards, the CFA ethics questions, that's pretty clear, right? Because we're just taking like the CFA questionnaire that you ask. There's like a right answer and a wrong answer. For the complaints, so this we have a spin-off paper just talking about the methodology for the complaints. When I extract out the scenarios, right, I have to like get the story behind this. The context is quite important. So, so in the 15 scenarios there, those are the stuff from the complaints. Yeah, so there you have like this setting, right? Client is optimistic about market and wants a market-linked product. The advisor recommends a structured note involving multiple indices, FX hedging, and barrier options. Full structure and risk are explained in detail. They want to allocate 20% of the portfolio, and then we have to create like this gradation, right? Like A, it's clearly excessive. B, risk is noticeably exceeds client status. So we have to structure it that way. And we do the scoring based on distance. So for the complaint outcome, we know a complaint is effectively like an example of bad behavior, right? Where the client was not happy. And so the closer the advice was to the actual detail of the complaint, okay, yeah, it's like a semantic distance to say, look, that's like kind of the failure mode.
Got it.
Yeah.
And that was human, like expert driven, like the analysis of checking the distance, that was human expert. So
the semantic similarity is still done with a large language model. It needs to be like a pretty good reasoning model, actually. Right. Like DeepSeek does pretty well, Claude does pretty well. Because actually, like there are a lot of details inside the complaint information. And the challenge is if you use a model that's like too coarse in some sense, like mixture of experts that's not big enough, it doesn't reason, you actually lose some of that information. Yeah, so that's like part of our kind of companion technical paper, I guess, explaining exactly those steps and like where you need certain capabilities for certain models. Yeah.
Thank you.
But honestly, the nice part is like once you have these questions, you're right, like we extract this stuff, and then now I have to like ask proper financial advisors to see like, are these questions reasonable? Yeah, so that's the start. So that's stage 4, right? Expert review. After you extract all this, like finance professors look through it.
Right.
Yeah. And the nice part is you can take that scenario and then cross it with all the other demographics, right? To kind of get more questions. Yeah.
Okay. There was a big movement towards still using AI, but using mostly quantitative-backed AI, right? Where it was mostly about diversification of asset classes itself, giving you alpha in the wealth management space. Now, I'm just trying to see, I haven't heard much on that front. Do you have any metrics on how these people have done who tried to experiment with quant-based asset allocation? Have they gained AUM? Have they actually delivered on the returns?
Yeah, so at INSEAD, I teach the hedge funds class. They're extremely successful. Millennium, Citadel, all of these are effectively exactly those types of models. But if you ask like, hey, am I gonna get Millennium's LLM that's gonna teach me? Yeah, forget it, right? It's just pure trading. And so yeah, there's like this line of work that's all machine learning, like kind of high frequency market making. That's just like a very different area.
No, I'm talking about, these Betterment, Wealthfront sort of people who are trying to pitch this to the retail guys, not HFT stuff, but, just saying right asset class, right asset sort of allocation, equities, bonds, versus blah, blah, could give you much better performance versus a plain vanilla asset allocator.
Right. I mean, I think that seems, my understanding is that is fairly well accepted as fact, that you want to have more asset classes, especially if you have more than like 200K in investable assets. You kind of want to get into more asset classes. Yeah, there's like some work on deep learning for cross asset class optimization. I think it's a bit technical, and in some sense, it's I wouldn't necessarily call that like financial advice. Yeah. But pension funds do use those methods, right? And I think to your point, like Betterment and Wealthfront, they are great like starting points, right, to kind of get exposure into the market. I use Wealthfront. I almost went to work for them.
Anybody else?
Yes, sir.
Yeah, as Ben's friend, former finance professor, I would like to ask you a question since we are in Chicago, right? So Chicago have a famous Nobel Prize for behavior. So AI model could help us to deal with behavior bias. But on the other hand, currently now I'm doing more like financial stabilities, financial risk regulators. We worry about so-called AI can bring a lot of another risk, so-called black box risk.
Yeah.
I want to ask you a question in terms of how to balance in terms of transparency, as you mentioned. As we know, again, in Chicago, you guys have lookout cookies. If we know everything about the parameters, the weight,
Yeah.
so we can find out another way to arbitrage, or another way, we look at the famous Chicago campus in London. We have a beautiful Millennium Bridge. If everyone shoots in the same directions, we have a global game type of
Yeah, that's right.
type of a Charles-Goodhart law. So I would like to hear your insight in terms of what the boundary between black box or transparency, especially for AI, this kind of platforms. Thank you.
Yeah, that's a really good question. And I think from a systemic risk perspective, that's kind of separate. But the hard part to me is it's with financial advice, sometimes it's preferences, sometimes it's beliefs, right? And so if someone's preference is they want to invest in that kind of stock, or they believe it's going to go up, what is your fiduciary duty, right, as an advisor, to say like, hey, you want AI? I will give you an AI portfolio, but maybe don't just buy NVIDIA, but like to have a mix of stuff. Yeah, so I think that's why I think it's a human needs to be in the loop there. But you're right, I had time to wrestle with this. If you take the AI models and you scale it, right, at some point, prices have to clear, right? And so what am I actually doing in terms of, market efficiency and stuff like that? I don't know. But you're right, so there's a great paper by a guy at the Chinese University of Hong Kong in Shenzhen. He shows that effectively the AI-generated financial advice generates correlated noise, right? So it becomes like this sunspot, right? It just so happened to if you ask like DeepSeek will always go along China, right? If you ask OpenAI will always go along US. And so you kind of have those in there, right? But is that like good financial advice, or is that just kind of noise that now we're all going to use it? And it can actually cause more mispricing. It's weird, right? Like you have more data, and in the end, like we just use the same stuff. We just coordinate on the same things. So that's why I try very hard not to deal with that question, because it's too hard. I just deal with like the education piece. There's like this big literature, right, of financial literacy. I thought it's super sad, because pretty much it doesn't work. Okay, retail traders don't seem to get better. The only time they get better is they lose all their money and they quit. And like we have like so many papers on this, right? And so it feels like getting kind of low-hanging fruit stuff, like don't just buy 5 stocks. You can get like a lot of the way there already. Yeah, that's a non-answer.
One online question we have here: how can AI help advisors better serve clients and uphold fiduciary duties rather than replace them? Yeah,
so I think, if you think about the workflow for financial advice, a lot of it is kind of just straight up information processing, right? So if you have a private bank, you get bombarded with all these macro reports and all this stuff. I think where the AI can be very useful is you can take the macro report and actually cast it in the lens of like your actual portfolio. Because there's like a gap, right? So there's like all these reports, but like what does it mean for like the 8 stocks that I own, right? So I think that's where the AI can help fill that gap quite well, and that would help the advisor be more informed and more timely with the client. To me, that feels like low-hanging fruit. And I've spoken to some private banks that are trying to have this kind of co-pilot style, where you want to like reduce the information processing costs on the relationship manager, right? And have them spend more time, playing golf with you, right? Because that's kind of part of their value add. Yeah.
That was the next question. Kind of where are we at in the continuum of development of applying technology, applying these technologies in this space? Where do you think we're at? And in your own hedge fund management, how are you using these technologies?
So actually, I run a small quant fund called Chicago Global, all Chicago people. Where we have felt the most use is actually using the large language model to actually like interpret our signals in a way that a human can understand. So when you like buy a stock, right, it can effectively write a AI stock report, right? And based on the different quant signals that we have. And then people can ask it, like, why did you like this? What measure of valuation? Where did you get the data for, how many AI researchers this company is hiring? Things like that. Just kind of have people understand your investment flow. I think that's been quite useful for us. And then also in the client reporting. Now effectively they can just talk to my database. Yeah, so I thought that's been quite exciting. Yeah, but in terms of like other, we use large language models to process transcripts to get trading signals, but kind of everyone does that. And so the incremental, like real kind of business use case was actually in better reporting, more timely reporting, a way for the clients to interact much more. Yeah.
Do you experience much hallucination in any of this?
So mitigating hallucinations, of course, a very big deal. We solved it by giving it a Python tool. And so actually, we don't let it come up with any number. It will code something up and then interpret the output. So there's kind of ways to mitigate that stuff. Yeah, that's a very important question. Yes, Martin.
There is just an unbelievably growing amount of college programs, especially in Hong Kong, that are finance or finance related. The other is medical and paramedical related. Are those people destined to not get a job? or are existing bankers, the ones who are really well off, really well paid in Central, on Wall Street, are they going to lose their jobs?
Yeah, and UChicago has a nice Masters of Finance program.
2 of them, actually.
And so, yeah, I think placement is tough. So far, I think you already start to see junior roles. There's been a decline in labor market demand for those types of roles. But what I do think is these LLMs effectively, like you used to have a moat from knowing coding, that moat is effectively 0. So actually then where you would need more talent is actually people who know the domain knowledge. Like knowing the kind of finance theory, I think knowing the like where you can trade stuff for the different financial markets, that stuff I think becomes more of an edge. Like it used to be like if you could code, you can get a job in finance. And now I think that's no longer sufficient. You kind of need to know what you're doing. And that kind of goes back to like the economic principles. So that's why I started the talk with, Rich Sutton's point, right? It's like, forget knowledge. It's just have it experience and trial and error. Reinforcement learning will win. I don't know. I still can't quite, I haven't, moved all the way to that extreme yet. I think like the economic fundamentals are very important. Like this problem with the incentive problem, right, of these advisors, that's not going to go away. You give them code, you give them black box, they can actually make it worse. Right? Yeah, I think you'll kind of go like one lawsuit at a time until you kind of converge on some framework on how to audit some of these systems.
But is the banking workforce going to shrink while the undergrad finance majors expand?
So I'd say I thought the trend was towards double degree finance and like business analytics or something like that. But I don't know. It's, people thought like, oh, you have AI. And so we're going to not need so many people. But what happens is when you have AI, you have more productivity, you actually want to do more economic activity, right? So actually, you might end up having this big boom in the industry. Right? So if we can do like better financial advice and people can focus on the human relationship, I think that can easily make that market grow.
That was one of our online questions, actually. You started to touch on it. Is AI bringing new retail investors or new kinds and types of investors into the market?
Yeah, so I think there's been this big trend in retail brokerage to just kind of give people leverage and give people more trading. I really believe the next frontier is giving them advice. The problem was, if you had $10,000, it was not worth the time of a relationship manager coming to talk to you. That gap, the mass affluent gap, I think you can fill that with the LLM. And again, it doesn't have to get too sophisticated. It's kind of the basic stuff. You're kind of just asking risk reward, benchmarking, right? So those to me, I think, are low-hanging fruit. And I feel like having spoken to some brokers, that's kind of the direction they're trying to go. Just kind of giving them more information, helping them learn better. I'm very excited about that stuff.
Another question, if clients interact directly with AI tools provided by advisors, the advisor may still bear compliance responsibility for the advice delivered.
Yeah, that's an excellent point. That is correct. So if you let your clients talk directly to a chatbot, you, the advisor, who's still legally the intermediary, you're still on the hook. You can't say, hey, Grok said that. Grok said to sell your house and put it into Bitcoin. So there is like a legal responsibility, like that fiduciary duty is still there. To this end, that's why I think, I think like this paper is a little bit extreme in trying to take financial advice all the way like with LLM. I think in reality, it would be more like this co-pilot type stuff. Generally, you don't want to open the chatbot to retail because they're just going to ask, like, how can I beat the S&P? And that's not what this stuff is designed for, right? You should more think about like, hey, which supply chains are more disrupted by Trump's tariffs? Those are kind of like answerable questions. But people always say, find me the best stock. And I think the issue is the AI will answer, right? That's the thing. So you kind of have to constrain it a bit too. Yeah. So that's the guardrails, the alignment stuff.
Any other questions? Yes.
Yeah.
Data, right? Data is a foundation. So who are the big players in that space, and do you see any growth in that space?
That's a great question. So there's like been this huge boom in companies doing data labeling, right? Scale AI being one of them, right? Just got taken over by Meta. So that's why I felt like for this kind of financial advice, we wanted to start with, we process this 160,000 complaints, and I'll just give people the questions. So then it's now public good, right? That you can kind of build on top of that. Banks have a lot of internal complaint data. Imagine every call, right, where you have an upset client. So our framework is designed to effectively take that interaction and convert it into an eval.
But how do you get access to the interaction? So you need
I think a lot of this data is internal. There's like some work on things like federated learning, like how can we plug in our different machine learning systems in a way that still respects privacy, right? You kind of like share a bit of data to get access to a model, kind of like a trade association type thing. But I think that's kind of where things will go. But you're right, the data is important. So like we'll always start with the publicly available source, right? And then you kind of move towards more internal data.
One last question. Anybody? Yes.
Hi.
River earlier, and I guess they're doing due diligence for private markets. I wanted to ask, what is the scope of AI within private markets? Because a lot of the data is not really, like it's either proprietary or not really available publicly.
Yeah, so I know Wes quite well. He's one of the co-founder for Bright River. And that was a big problem. So they had to work with like a large client that had a lot of internal data and many deals already. But you can think about it as, I think the first step is like RAG. It's like, let's just search the due diligence documents to like find this, like, is this portfolio company good? A lot of it is like fairly low hanging fruit, right? Like I think where we get a lot of benefit from RAG is like, you just ask it for policies, right? Like you kind of search. Effectively, it's like a glorified search engine. There's some stuff that you could do to try to do things like estimate cost of capital, which is getting a little bit fancy. If you ask me, I think that's not where most of the value is. I think most of the value is in parsing these documents. Are there any non-standard clauses, things like that, that the AI is quite good at detecting. Yeah. But yeah, so I think, Bright River, they seem like reasonably successful in creating that big corpus, right, and parsing that. Yeah, but you do have to start somewhere. In this case, the big funds tend to do better, right, because they have more data. So I think increasingly, it's tough being a small asset manager. Yeah.
And on that note, thank you so much for your talk tonight, Professor. We really appreciate you coming down and being another one of our Nexus speakers today.
Great, my pleasure. Thank you for coming.
I'll trade places with you here and I'll close us out. Thanks for everybody who joined in person. I'm sure many of you have questions for Ben after the program. And I wanted to say thanks for those who joined us online tonight and eventually did send us in a few questions. We have a really interesting thing coming up on September 19th at 6:30 p.m. I don't know if not many of you look like you might have teenage student athletes, but our men's and women's basketball teams are coming to our campus on the 19th of September at 6:30 p.m. We're having a brief panel discussion to talk about what it's like to be. Chicago's not known for its athletics, let's just say that, okay? But we do have athletes, we do have a basketball team, and this is just a great way to learn about what student athletes go through when they come to Hyde Park. I think it's gonna be a lot of fun. We don't have any hoops set up. I wish we did, but if you have any young people in your families or people that you'd like to recommend, I think it'd be a fun event and hope you can join us. Thanks again for coming tonight, and we look forward to seeing you again.